Good afternoon. My name is Ann Duguid, and I'm here with Mark Ramler. We are from FINRA, and within FINRA, we work in FINRA's Office of Financial and Operational Risk Policy. I'd like to start off by saying thank you very much to the PCAOB for inviting us to their conference. We certainly appreciate the opportunity to share the information that we have about broker-dealers and their financial and operational reporting to all the auditors today and the series of conferences that the PCAOB hosts. And I will mention that what Mark and I have to say is our views and not necessarily the views of FINRA. So we like to throw out a little bit of a disclaimer at the beginning in case there's any misconceptions or anything. Certainly ask questions throughout the presentation. I would like to start off with explaining where Mark and I fit within FINRA. So within FINRA, there's several different groups. There's there's the market risk group, there's member supervision, and then there's examinations, and then there's the Office of General Counsel. So within FINRA, Mark and I are within the Office of General Counsel, and it's a small group, and essentially what we do is, to the extent that member supervision or examination folks have interpretive questions, generally specific to net capital, customer protection, books and records, accounting, annual audit, things like that, they will come to our group with interpretive questions that aren't straightforward. There are certain scenarios that come up from time to time are not cookie cut based on actual rules that are out there. So we work in that group to try to provide interpretive guidance for these rules. And other things that our group does is, to the extent that there's any new rule interpretations that are created, we get involved in that. And we have several other projects that we work on throughout the year. So the purpose today, we're going to try to deliver information that's helpful to the auditor community, some things that are coming up as far as rules and regulations and things that we see throughout the year. Let me see, moving right along. So today we're going to cover a couple of hot topics. So these are either new rules and things like that coming out, recent regulatory guidance. Certainly FINRA is constantly sending out regulatory notice and information notice to the industry, things that we may think are helpful to either the broker-dealer firms or anyone involved with our firms. We're going to share some observations that our surveillance or exam teams have seen through examination. We're going to talk about the exemption reports, and then we have we want to share some resources that we have at FINRA. Okay, so as far as and we have CPE codes. So the first CPE code is 832. Don't want to forget those. Those are very important. Okay, hot topics. So the first thing we want to fill everyone in on is the daily 3-3. So the SEC proposed a rule in July of 2023. This rule, there's been a lot of talk in the industry about this rule. It's expected to be adopted in 2024. We can't say for certain that it will be, but that's kind of the general consensus that it would be adopted. The compliance date with which daily 3-3 would need to be done is still a little uncertain. We understand that the SEC will certainly provide sufficient time for firms to get up and running on a daily 3-3. So just to give a little bit of background, why did the SEC propose this rule? Essentially, the 3-3 is the customer protection rule. So this is a calculation that currently is done by about 200 firms, and it's done generally weekly. And with the speed of the markets and the volatility of the markets, it's kind of almost clear to see that at the end of with every calculation, there's a certain amount of customer funds that need to be locked up and set aside. And that calculation is only done weekly. And with the volatility of the market, bringing those firms that have a lot of customer exposure to do a daily 3-3 seems like a better matching of risk versus protecting the customer. So that's kind of the overall thought process on why the rule was proposed. As I mentioned, there's about 200 firms that do a 3-3 calculation. It's estimated that about 60 of these firms would have to do a daily calc. And those firms are firms that have average customer credits of 250 million. So these, obviously, the daily requirement is only for the largest of the firms that have a lot of customer activity. Obviously, some of the issues that are anticipated is getting operationally up to be able to do a daily 3-3 calc. So that's a lot of work that certain firms are going to have to do to automate the 3-3, to get staffing in there who understand the 3-3 and do the calculation. So that's one rule that we wanted to kind of make sure auditors were aware of. And again, it's not going to impact year end 12/31/23. And it's expected, potentially it might impact 24, but it might even impact 25. It depends on what the SEC's compliance date is going to be, which we don't know what that is. The next rule I wanted to talk about is the SEC's electronic filing rule. So this rule was proposed in March of 2023. This rule impacts firms other than broker-dealers, so not just broker-dealers. It impacts a lot of different types of firms that are reporting into the SEC. So the SEC is going to mandate that firms do their required reporting into EDGAR. So specifically, today, broker-dealers may elect to submit their annual audit via EDGAR, but they're not required. So when this rule is adopted and the compliance date is established, as of that compliance date, all broker-dealer firms will be required to submit their annual audit via EDGAR. In addition to EDGAR, the rule talks about required XBRL formatting. And so that is machine readable formatting. And so we understand that all broker-dealers, all firms that submit annual audits to SEC are going to have to put those annual audits into XBRL formatting. And again, state with that could be extended for like smaller firms. So we don't know exactly the compliance date, but again, this will not impact 12/31/23 year ends. And then in addition to that, included in the rule, there are certain changes to the focus report. There's some, additional lines that are going to be added to the Part 2 and 2A report. And of special note is in the focus Part 2, there's going to be 2 separate pages now that will require reporting of SEC minimum net capital, the net capital calculation per the SEC rules, and the CFTC rules. So there's going to be 2 separate calculations because under each of the rules, there's different minimum net capital requirements. And just one thing I wanted to mention with respect to submission of annual audits. With COVID, there was the ability that if firms had difficulties as a result of COVID, they could submit their annual audit via an email function to the SEC. Now, while the SEC hasn't repealed that guidance, the expectation is that firms are no longer suffering COVID-related issues. So firms should not be submitting their annual audit via that email option. So we just wanted to make sure you were aware of that. And now I'm going to pass it over to Mark to give an update on SAB 121 and RevRec.
Thank you, Ann. Before I go into Staff Accounting Bulletin 121, I just wanted to make sure that all the participants understand that the SEC Office of the Chief Accountant has accounting oversight of both public companies and broker-dealers. So now let me talk about SAB 121. Now, it came out in 2022. It was somewhat of a shock to the financial services and banking industry, and it covers safeguarding of crypto assets held for platform users, meaning held for customers. And it's concerned about the risks and the uncertainties of holding crypto assets, being a custodian for crypto assets. So the SEC OCA was so concerned about these risks that they they required firms that had a safeguarding obligation to record a safeguarding liability on their balance sheets with an offsetting asset. And that's only because, credits, debits have to equal. And the asset and the liability are reported at fair market value. So the interesting point around this, staff accounting bulletin is it not only applied to the entity that held the crypto assets, it applied to agents or affiliates who were sharing a similar platform. So if a broker dealer was directing customers to its crypto affiliate, the firm would be required to apply this accounting. And therefore, we had firms that had to recognize a large liability for their safeguarding of crypto assets, even though the broker-dealer firm wasn't holding anything. It was their affiliate with an offsetting asset. When this was discussed with the SEC Division of Trading and Markets, they advised that they knew of no basis to treat the asset as allowable. And they also indicated that the liability could not be added back to capital to try to offset the asset. So the firms that did apply this accounting had to take some very significant deductions. Now, the AICPA stock brokerage expert panel had been having discussions with the OCA from 2022 when the SAB was issued. And in February of 2024, they met with the staff. And, the staff outlined a fact pattern that if firms follow this fact pattern, the OCA would not object if a broker-dealer was not recognizing the safeguarding liability and the offsetting asset. So after that, the SEC Division of Trading and Markets advised that if a firm was making progress to changing its business model to meet the fact pattern of the OCA, that broker-dealer could treat the asset as allowable and can exclude the liability from AI. But this is only temporary guidance, and firms will have to be making progress towards changing their business model. And I'll stop there. And any questions?
No, I think that was a good summary, Mark.
All right. Now we have a topic that's maybe a little broader. So FINRA exam staff has continued to see firms misapplying ASC 606, accounting for revenue from contracts with customers. And they primarily see this related to M&A transactions, whereby firms are recognizing retainer fees upfront, either when the retainer fees are billed or when they're collected, without considering whether the performance obligation was satisfied or not. And for those firms where the performance obligation was not satisfied, those firms should have deferred the revenue as a liability. The result of that would be to decrease the firm's net worth and decrease the firm's net capital. Additionally, for these firms, when we ask them for their accounting policy or accounting analysis to support the basis of their accounting under ASC 606, they're not able to provide us anything. And if you ask them, what's the basis of their accounting, they'll say something to the effect that this is how we've always done it. And then finally, when we read the footnotes to some of these firms and we compare what's outlined in the footnotes to how the firms are accounting for the revenue, it's inconsistent with the footnotes. So all we can say is that our exam staff will continue to look at this area, and they tend to look for revenue recognized that they believe is outside of what they would expect to be accounted for under the standard. And I'll stop for any questions.
Let me put down the questions. No, I don't think we have any questions on that one.
Okay.
All right, so moving right ahead. The next slide, we're going to cover some recent regulatory guidance. As I mentioned, FINRA from time to time will publish regulatory notice just to heighten information sharing on certain topics. So I think Mark's going to take the first couple, and then I'll take the last couple.
So you might find the first information notice helpful because that lists the dates when annual audit reports are due. And that includes the 60-day filers as well as the small firms that are taking advantage of the extra 30 days. Plus, it has all the other focus reports and schedule due dates. So you might find that helpful. Regulatory notice 2302 is a reminder, and it covers basically what I just spoke about, the revenue recognition, but I think you should take a look at it because it does affect a lot of firms. And, I skipped the customer statement. Sorry about that. So FINRA had two customer statement rules. They had 2231, and they had the old New York Stock Exchange 409T rule. And 409T was a little different, and for compliance purposes, firms had to follow both. So effective January 1 of this year, those rules were merged into 2231, so there's no longer two rules, There is now one rule to follow. It should have no impact on a firm's compliance report or the examination report. Since it was effective at the beginning of the calendar year, if you had an off fiscal year end, you basically had to comply with two rules for part of the year and then one rule at the end of the year, but it should have no substantive effect.
Okie doke. So the next couple of notices we're going to talk about is the 2311, that's liquidity risk management rule. So normally with a rule process, the initial notice to the public is kind of a rule proposal. So because of liquidity, FINRA is working on creating a liquidity risk management rule. So that's basically a rule that's going to apply to all the FINRA members, that they should have a system in place to monitor liquidity, whether it's day-to-day liquidity needs under stress testing. And, we're trying to put this rule into place. So because it's complex, what we did instead of just proposing a rule is notice 2311 was a concept proposal. So it's like a pre-notice before we would do a rule proposal. And so this actually came out in 2023. It came out in June of 2023. And it was a request for comment, and comments were due by August of 2023. So that's sometime more than a year ago. So we did receive lots of comments. The staff that is working on it has tried to do their best to address all of those comments. And the expectation is, over the next couple of weeks, couple of months, we are anticipating to come out with another regulatory notice that's going to be more refined with respect to comments relating to a potential rule. So that's a liquidity risk management rule. And just to avoid confusion, there is a separate report. We call it a supplemental focus report it's a supplemental liquidity schedule. That is a schedule. It's a reporting of sources and uses of liquidity. That's something that went into effect in 2022. So that's a reporting of sources and uses of liquidity. That's one thing FINRA is utilizing to monitor a firm's liquidity situation. But in addition to that, we're working on a liquidity risk management rule. So that's something that's in the works. So I just wanted to clarify that. And then the next set of notices relate to Reg T, and they relate to T+1. So there's actually a lot of information on FINRA's website regarding any questions regarding to margin collection relating to T+1 changes. There is the T+1 process was implemented on May 28th of this year. And we have not heard of any systemic issues related to T+1, but in preparation of this, there was certainly a lot of information that was set out to the public. And I know there were certain questions regarding margin and margin calls with that. Relating to margin, Regulatory Notice 2314 talks about the amendments that were made to FINRA's Rule 4210, which is, margin requirements related to covered agency transactions. So this rule was adopted by the SEC, and its effective date was May 22nd of this year. So again, there's a lot of information on FINRA's website. This rule relates to covered agencies. So that's TBAs, that's government-sponsored CMOs, that's specified pools. So to the extent that your firms are engaged in this activity, it's helpful to understand that they have margin requirements. And there's a lot of things within that rule. For example, you can take a capital charge in lieu of collecting a margin. So it gets kind of complicated. We're not going to go into any level of detail, but just to let you know that that is a new requirement in 2024. And there's lots of information on FINRA's website about that. And we did get a question in that someone asked, I guess they heard through the grapevine that the SEC was considering revoking the additional 30 days. So that 90-day period that firms could take advantage if they met those criteria. I have not heard that. So I'm not sure where that came up, but I have not heard that. As you know, I would feel comfortable saying that the 90-day due date, which is the 60 days plus the additional 30 days, we are not aware that that's going to be repealed. All right, so moving right along, we're going to move on to the next slide. Oh, no, we're not. CPE code. CPE code 104. That's our next CPE code. Okay. And now hand it over to Mark to talk about exemption reporting.
And maybe I'll just give so far for the CPE codes, because that's very important to also Anne and myself. So the first one, if you missed it, was 832, and now you have 104. Okay. So we continue to see misstatements in firms' exemption reports. And I thought it might be helpful to go over some key concepts and considerations around the exemption report. So when you think about the exemption report, it covers the broker-dealer's operations for the year. And it covers the types of business activities they're doing as a broker-dealer. And for those business activities, we have what's called covered activities and non-covered activities. So covered activities would be those activities that fall under the exemption provisions of 15C33, paragraph K. And we have K1, right? So K1 is for firms that sell mutual funds and variable annuities. That's all the firm can do. It's exclusive. If the firm does any other type of securities business, it would not qualify under that exemption. And we've seen firms just this past year who claim K1, and they did investment advisory business, and that was a misstatement. Those firms should have claimed, I'll go into it, footnote 74. Next we have K2I. Now, K2I is for firms who carry no margin accounts and promptly transmit customer securities and funds through an account for exclusive benefit of customers. And this would be self-clearing firms who are doing DVP, RVP transactions. And we also see a lot of firms claiming K2I, but they're not operating under K2I. And finally, there's the K2II exemption, where firms are clearing on a fully disclosed basis through a clearing broker. Now, for the covered activities, firms have to state whether they met the exemption without exception or with exception. And if they met it with exceptions, they would list the exemptions. Those exemptions are typically that they did not promptly transmit customer checks within the required timeframes of the rule. So non-covered activities are a little different, right? So non-covered activities are all the other activities that a broker-dealer does. Proprietary trading, direct mutual fund business, M&A business. And those uncovered activities fall under what's called footnote 74. And footnote 74 came out of the amendments to Rule 17A5, the 2013 amendments to Rule 17A5, which created the exemption report and the compliance report. And if you went to the FAQs concerning the July 30th, as you see on your screen, 2013, you would see there is a question 8, and in that question 8, it outlines what the SEC viewed as footnote 74 activities. And it lists proprietary trading, direct business, contingent escrow offerings, things of that nature. But that list is not inclusive and it's not exclusive. So if a firm is doing other activities, they could put the activities that they're doing, how they're operating in there. So it doesn't necessarily have to be those activities. And if they're not doing the activities that are listed there, then they shouldn't list them in their exemption report. Now, for an exemption report, the key statement that a firm is making is that it did not hold customer funds or securities for the year, or if it did receive customer funds, it promptly transmitted those customer funds. Because for certain activities such as direct mutual fund business and contingent offerings where you have to promptly transmit customer checks to an escrow agent, the prompt transmittal still applies under those activities. But a firm cannot hold customer funds and securities and be eligible to file an exemption report. If a firm holds customer funds and securities, that firm would have to file a compliance report. And if you think about it, Rule 17A5 is a different rule than Rule 15C33. And you can have a firm that is in compliance with its exemptive provisions under 15C33, but may still have to file a compliance report. And I'll give you an example. So if you had a firm that cleared on a fully disclosed basis, a K2 II firm, and they executed customer transactions at different trading venues, and the trading venues sent order flow rebates directly back to the firm, not the clearing firm, and the firm, pays rebates back to their customers directly. if the firm deposited the rebate funds into an account for exclusive benefit of customers and effected payments out of that account, that firm would still be in compliance with their 15C33 K2II exemption. Yet they would have to file a compliance report because they're holding customer funds. So I guess the bottom line is that you don't have to just be a clearing and carrying firm to have to file a compliance report. And I'll stop there. Are there any questions?
I don't see any questions on exemption reports. There was a question going back to revenue recognition regarding investment banking retainers. And so essentially the question is like kind of short and sweet. I think retainers wouldn't, is not straightforward like how you would account for them. I think what we would recommend is that every firm needs to have policies and procedures regarding how they satisfy ASC 606. If you receive a retainer, what is it for? What are the performance obligations within the contract that relate to the retainer? And when were those performance obligations satisfied? So I think we're not able to give a straight quick answer to how do you account for the retainers. It depends. It depends on what the contractual obligations and what the performance obligations are for those contracts. But when a FINRA examiner comes in, they're certainly going to want to ask for, what are your policies and procedures? Show me the contract. Show me the contract analysis as required by ASC 606. So Mark, do you have, I'll defer to you if you want to add anything onto that.
Well, a retainer is nothing more than a receipt of payment. So how does that, so the key thing about, the old accounting for revenue recognition that was all over the place, look to if the service provider was making progress and providing service, right? And then you could recognize revenue. Under ASC 606, it doesn't look at the service provider. It looks at the customer. Is the customer getting some type of an asset that they could use? Are they getting a benefit that they're consuming or something like that? If the benefit doesn't come until the end of the contract, let's say a capital raise, then maybe the performance obligation should not be recognized until the capital raise. So this is a totally different concept. It doesn't matter how much work the vendor does, but the customer has to derive a benefit for there to be a performance obligation. And then there's always the question, is the performance obligation recognized at a point in time, or is it recognized over time? This is very complex and it takes analysis. But if firms believe that they could there are many revenue areas that did not change between the old GAAP and the new GAAP. But one of them that did was the accounting for M&A transactions.
Right. And that's where we see it, and that's where our examiners are raising questions. Okay, so moving ahead. Exam observations. So I know this is definitely a helpful segment that we usually have. The auditors like to understand what deficiencies FINRA is seeing during exams. And we will point you to the fact FINRA publishes every year their annual regulatory oversight report. There's several sections to that report. One of those sections is financial and operational items. So the 24 report is out. They are working on a 25 report as well. So when that gets published, you should certainly look for it. We wanted to give you a few highlights from that report. Certainly, I won't spend any time with RevRec, but RevRec is in that report. I think every year a perennial item is expense sharing. So one thing to share with the auditor community, um, that many, if not every single broker dealer has some sort of expense sharing arrangement with an affiliate. And we often talk about expense sharing and management services. So there's a FINRA Notice 0363 that gives a lot of guidance on expense sharing. And actually not that recent, a little while ago, there was a new interp that was published related to management services. And those things are also mentioned in the annual reg report, but just in short, when you see these, when we see these, the first question we ask is there a written agreement between the broker-dealer legal entity and an affiliate? What is it for? Is it a third-party expense, or is it services that are being provided by an affiliate to the broker-dealer? And we want to understand if those expenses what is the expense for? Is it reasonable? Is the expense reasonable for the service provided? Is it applied consistently? And the whole purpose of all of this, just as an overall thought, is that their broker-dealer financial statements should be for the standalone legal entity and should fairly reflect the broker-dealer's financial situation. So those expense items are important to us because to the extent that expenses are overstated, that could potentially be a disguised capital withdrawal. And that's, something that our staff looks for. So expense sharing is something we wanted to mention. Other things that come up in exam, contingencies, especially important for auditors. At every month end, when firms submit their focus report, the estimable and probable and whether an accrual should be made for either an arbitration or a lawsuit or any other type of contingency, that's often a item that potentially could put a firm out of net capital compliance. So that those items can be material and meaningful. Guarantees. Appendix C, paragraph D, is something that I would like to point everyone to in their spare time. They could read it. A broker-dealer should not be guaranteeing an affiliate. So what we do see from time to time that is problematic is, without the firm understanding the net capital implication, perhaps the broker-dealer becomes a guarantor on a loan that's made from a bank to the parent of the broker-dealer. And to the extent that the broker-dealer is guaranteeing that is an immediate capital charge. So the guarantees is something else auditors could look for. A couple other things accrual accounting. It seems super basic, but you would be surprised how many times we see firms making like cash-based entries where accrual accounting, because of the thin capital margins, could potentially result in a capital issue. Open contractual commitments. So these are the underwriting commitment charge. Our examiners definitely go in and they look at firms that are engaged in underwriting activities. And there are underwriting activities that are committed underwritings, and there are underwritings that are best efforts. So to the extent that there's a committed underwriting, there's open contractual commitment charges. Sometimes the deficiency with those is clear notification to the broker-dealer that if it was a committed offering, when was the broker-dealer, off the hook, like their commitment was satisfied or they're no longer committed to the deal. The timing of that notification and the moment-to-moment net capital compliance is something that firms that are engaged in that activity from time to time have an issue with. And so those are some of the things that we've seen previously that we think that are important to you guys. Things on the horizon that FINRA examiners, with the application of FINRA Rule 4210 and moving margin related to TBAs, at some point in the future, FINRA will probably be looking at that, to ensure firms are affirming and confirming moving the margin with 4210 and also with T+1, going into the firms and looking at their operations with respect to affirming and confirming for T+1. But as of now, we have not heard of any exceptions related to 4210 and T+1, but that's something I just want to mention to keep on the horizon, that if you have firms that are engaged in that type of activity, eventually, the next time FINRA is in on an exam, FINRA, I will mention, does a risk-based examination program. So it's not like FINRA would do like automatically examining for certain things when they go into every firm, but on a risk-based approach, they might look at those. I'm watching the time a little bit too. So Mark, do you have anything else that you want to?
There's another question. This
Okay.
appears to be more of an audit question, but I'm going to read it. When 12B1 fees are direct and determined from a mutual fund, the collection and acceptance by the broker-dealer addresses I think he means the VA, the valuation and accuracy assertion, correct? Now, I can't see our colleagues from the PCAOB. I could give you my viewpoint on it, but I'm not, this is just me speaking. Um, I don't think that's correct. So in order to test the accuracy, you may have to look at a SOC 1 report, and you may also have to recompute certain transactions to get comfortable with accuracy. You have to look at the controls behind the transfer agent, what they do, what your firm does in determining accuracy, what can be relied upon. And it seems to me you also have to do some reasonability testing to see that the amounts you're getting are accurate. Valuation, that's a little easier because you could get that information from the fund and figure out what the valuation should be. But it's not as simple as just you collect it, you report it, and therefore you've addressed all the assertions that you have to address. And I don't know if anybody from the PCAOB wants to
Maybe they could do that later in one of their sessions later on.
okay.
All
So
right.
I didn't want to let it go since it was in our session.
No, thank you, Mark. Okay, so moving right along. I believe everyone's going to have access to the deck. These are links. These are all links to a lot of information on FINRA's website. There's a lot of useful information. There's an FAQ on how firms fill out the OBS report, how they fill out the supplemental inventory schedule. And again, lots of information on various things. There's digital assets. There's a lot of information on FINRA's website. Hold on. I think we have another CPE. Right. The next CPE code is 317.
So
317.
So the codes were 832-104 and now 317.
Mm-hmm. And I think that's pretty much it. I think we've run out of time. We've addressed, I think, most of the questions. Someone asked before how many about the 90-day, the additional 30 days. And we do have some statistics on some of the annual audits of all of the broker-dealer firms, right? About 90% of all broker-dealer firms qualify to avail themselves of the additional 30 days. But for December 2023 year end, only of about 50% of those took advantage of that. of those that had the 12/31 year end. So it is interesting for us. We're definitely not aware that that's going to be repealed. But it's, what we've heard as far as feedback, as certainly some firms appreciate the additional times. Some firms appreciate the ability, for auditors to stack their audits. So now if they have the additional times, the auditor can take on their engagement. But then other firms also just love to get the audit done and not drag it out and love to send it in. So, just thought we would share that. But that's pretty much it.
All right.
We want to say thank you very much to the PCAOB for having us.
Thank you.